In part one of this series, I told you financial advising is dead. In this video, I take it one step further. The tools that we were taught to use, mutual funds, annuities, 9 to 4 stock markets, they're all museum pieces. We're moving into an area of 24/7 stock markets being open. Imagine, instead of waiting for a mutual fund to rebalance on a quarterly basis, owning the underlying stocks in baskets for basically zero commissions, zero trading costs, instant liquidity, the ability to buy and sell as you feel necessary. Why would you settle for a 5% safe return when you can have access to tokenized assets in some of the most exclusive companies in the world? I'm talking about companies like SpaceX, OpenAI, Anthropic, Perplexity, Figure AI. These are some of the most innovative high-tech companies out there. They're historically been only available to millionaires and multi-billionaires. The average investor simply could not get into the door. That's starting to change. Between tokenized assets, fractional ownership, and new market structures, more investors are beginning to get exposure to high-growth, innovative companies like AI and space technology. There are no guarantees, and these investments come with real risks, but the opportunity set is expanding. There's an important catch, though. A lot of the industry still sells a comforting story. They're telling you that there is a way to invest that creates a smooth, consistent, predictable ride in the stock market with all of the upside and none of the downside or the gut-wrenching, stomach-churning volatility that exists. I'm here to tell you that is a myth. Volatility isn't a bug. It's the price of admission. If you want the potential of life-changing growth, whether it's in a fast-growing company or a volatile asset class, you have to be willing to tolerate uncomfortable moments. Sometimes that price shows up as red on your statement when the market dips. The question isn't, can I avoid volatility? The question is, am I willing to accept it in service of the destination I'm aiming for? There's a famous study that was conducted by the Motley Fool in 2 hypothetical portfolios. In the first hypothetical portfolio, there were 2 stocks, both of which went up 70%. So let's say $100 of this portfolio got invested, 50 in each stock. Each stock went up 70%. The total portfolio is worth $170. Portfolio B, on the other hand, had 2 stocks. Again, both had $50 investments. The first stock went completely bankrupt. The $50 went to zero. The second stock went up 1,000%, 50 going to 500. Most people were asked, which portfolio would you rather have? Portfolio A or portfolio B? And it was remarkable to see that actually the audience was split evenly between portfolio A and portfolio B. Go ahead and comment below. Would you choose portfolio A or portfolio B? What we tend to see is that people who choose portfolio A care more about the consistency and smoother ride, while people that chose portfolio B care more about the final destination, the total outcome, even if the journey is bumpier. This group gets it. Number one, they understand that massive growth comes with massive swings. Number two, this group values simplicity over hand-holding and pep talks. And number three, this group wants to own the future. Crypto, tokenized assets, the most advanced AI companies, not some relics of the past. If you hear all of this and understand that volatility is often just the market's way of shaking out short-term thinkers so that long-term owners can get rewarded, then you're in the right place. This is the end of the pure advice era and the beginning of the implementation era, where the real edge isn't just knowing what to do, it's actually getting it done. If you want to learn how we're positioning portfolios for this new environment in 2026, head over to our website and take a look at how we build and manage our strategies. The future is coming. Are you going to watch it or are you going to own it?